What's going on, you guys? It's Marcos. So if you own a house and a Google account, I'm willing to bet that one of the most common ads you see is about refinancing your mortgage. And you may be wondering if refinancing can actually save you any money in house. So in today's video, I'm going to show you 3 different ways how you can save money by refinancing your house so that you can see if doing so makes sense for your own personal situation. Now, the best way I can show you this is with pretty colors and memes. Just plain, let's take it with this example. You own a house for $600,000 and you owe $400,000 on your mortgage right now, and your current interest rate is 4.25%. Now, when you refinance your mortgage, you have certain expenses such as the closing costs, and these closing costs could be anywhere between 2 to 3% on average. Now, these can get rolled into the loan or you can pay them out of pocket. Now, I've personally done over 800 refinances in my career, and I can probably count with just one hand the number of people that have paid their closing costs out of pocket. So I'm gonna be assuming that you're gonna be rolling them in if you do refinance. And that means that at 3% in closing costs, that would be the equivalent of about $12,000. So 3% times 400,000, 12 grand. Do it for your own calculation of whatever you own your mortgage. Now I know what some of you guys might be thinking. Oh my God, $12,000 in closing costs. That's such a ripoff. Look, I'm gonna show you why the $12,000 is gonna be looking like a bargain. And it's gonna be different for each one of you guys. Obviously, everybody's situation is gonna be a little bit different. This is just for my example theory. Now, the most common type of refinancing is by lowering the mortgage rate and your lower payments. With a $400,000 mortgage at 4.25%, your principal interest payment is going to be roughly about $1,967 a month. And over the life of the loan, you will pay roughly about $303,000 of interest payments. Now you can see why the 30-year mortgage is the best loan for a bank. So anyways, you go around on the internet and you see that mortgage rates right now are hovering somewhere around 3.2%, and you're a reasonable person and you agree that, well, there may be some savings by refinancing your loan. With a new mortgage of about $412,000, that's the $400,000 that you owe plus the $12,000 in closing costs, and with the new rate at 3.25%, your new principal and interest will be roughly about $1,793 a month, which means that you will be saving roughly about $173 every single month. Now, to some people, $173 is a big difference. To others, that could be just chump change. But listen, this is where things get really, really crazy. Because with the new loan, you will pay roughly $233,500 in interest, meaning that your new lower interest rate will save you roughly about $70,000 in interest payments. But this is not all. Sure, you could take the $173 a month and stash it into a savings account for the next 30 years. After 30 years, you will have roughly about $62,000 in today's dollars. But honestly, that would be more like $24,000 after inflation. But you're a smart person, and what if you took the $173 a month and you put it into a compounding account over 30 years by investing every single month? Now, you could do this by buying fractional shares of the SPY ETF, ticker symbol SPIDER, which tracks the entire S&P 500. Now, the SPY has returned a little bit over 10% since its inception back in 1993. So after 30 years, assuming that it does continue to return about 10%, you will have roughly $380,000 just because of the power of compound interest. And there you go, that's the end of the video. If you're not convinced by now, then I don't know what else to show you at this point. Fine, I'm gonna make do with my promise and show you the 3 actual different ways. So I got 2 more to go. The next one is gonna be by lowering the term of your mortgage. So most people actually think that doing a 30-year loan is the only mortgage loan out there. And in fact, well, it is the most common one. It's the one that gets offered the most. But for most people, getting a 30-year mortgage offers obviously the lowest monthly payment because the loan is extended over 30 years. But very few people actually know that the lowest interest rates are actually offered to those who get the lower term mortgages, typically like 15 years or 20-year loans. 15-year mortgages tend to get you the lowest interest rates. So if you refinance the same loan at 2.25% on a 15-year mortgage, instead of doing a 30-year loan, you will just pay about $73,000 in interest, which roughly will save you $230,000 in interest payments, and obviously it will cut down 15 years of your loan. The downside is that it will increase your monthly payments by about $730 a month. To some people, getting that payment increase is a little bit tough. But obviously that is like the easiest way of saving money in interest payments and also saving a lot of time because, well, 15 years is 15 years, right? Now, finally, the third way is by consolidating debt. So if you have things like credit cards, personal loans, and stuff like that have a much higher APR and a much higher payment, then this will definitely be advantageous to you. So say for instance that you owe $30,000 in credit card debt, then consolidating your unsecured debt with your mortgage may make total sense, and this is why. So assuming that you're paying a 3% balance of your credit cards every month, that's the equivalent of $900 a month on credit card payments, which means that between the current mortgage payment of $1,967 a month and the $900 a month on credit cards, you're coming out with about $2,867 out of your bank account every single month. Now you could take a new mortgage for $442,000, which is whatever you owe plus your closing costs plus the $30,000 in credit cards that you owe, and roughly a 3.25% on a 30-year loan, just to kind of give you that lower monthly payment. You will have a payment of $1,923 a month, which, as you can see, it's still even lower than what you currently owe right now on your little mortgage. Now, over 30 years, you will pay roughly $250,500 in total interest, which, well, still even saves you $53,000 in interest compared to your mortgage right now. But you could actually maximize your savings by doing either of. You can reinvest $900 in savings back into the loan by prepaying your mortgage. So mortgage loans typically don't have any prepayment penalties, so whatever additional payment that you make will go towards the principal at no fee to you. So instead of making a monthly payment of $1,923 a month, you will make a total monthly payment of $2,823. And because you're attacking your principal, you will pay off your loan in roughly 17 years. So there you go, I just helped you save 13 years on your mortgage and a ton of money in interest. Or you could do this. You could take the $900 a month in savings and reinvest it into a compounding account, just like I showed you in the first example. And in 30 years, just get ready for this. You will have a total of $1.9 million by putting $900 a month into a compounding account at 10% interest rate, starting with just $1,000. So there you go. I just showed you how to become a millionaire by restructuring your mortgage and your debts, and I think that deserves a like and a subscribe. See you guys on the next video.